Do you want to start investing with DEGIRO? In this video, I promise to explain everything about buying and selling stocks through DEGIRO. How it works, the platform, a few important tips to keep in mind. Also, reduce key costs, but never. And finally, a bit of advanced explanation about buy orders, limit orders, but also what should you actually pay attention to when valuing a stock. We're not going to go too deep into it, but just the basic principles for inspiration to understand that buying and selling stocks is relatively easy to do. With just a few clicks of a button, you can do it. However, there is a lot to understand beforehand, what you need to do to understand what a stock is and how to buy it from a company. So keep that in mind. In this video, it's all about an explanation for stocks, buying and selling at DEGIRO. Now, 30% of you are not subscribing on our videos. Do you find our videos valuable now? Has it helped you? Then it would be a small effort. And I would really appreciate that if you take a moment to subscribe and like the video. That helps our algorithm grow, and that's how we get bigger. We can invest more money in better videos, which also helps you, of course, with content for simple investing and achieve financial freedom. My name is Jorik van Meulen. I've been investing myself for over 10 years, mostly at DEGIRO. So I came to explain a thing or two about how the platform works, and let's take a look at that.
My promise to you for this video is that you'll get a complete explanation about the key aspects of buying and selling stocks on DEGIRO as an investment platform, and you can apply these principles to various other investment platforms because fundamentally they all work the same. First, we're going to take a look at the general overview of the DEGIRO platform, in this case, with some basic things that are good to know. Then we're going to take a look at the cost overview, why that is also important. And we're going to look, of course, at the difference between buying and selling, stop loss orders, limit orders, what are they and how do you apply them, that kind of stuff. That covered a few important basic principles and concepts for valuing stocks, because that's obviously much more important than just buying attractively and selling quickly. And that's definitely something I want to share with you. Be sure to check out our other videos on our channel. Subscribe to it for the latest videos because we explain how to value stocks. Even with 10 years of experience in the world of investing, valuing stocks is the most important thing. What you need to do to limit your risks and potentially achieve higher returns. Log into DEGIRO and you'll see an overview of what you can see here. You see the balance displayed. That's the total amount of money in the DEGIRO account. Then you see the portfolio. Here is the amount that has been invested. Then you also have a portion of your free capital. That's shown here in this case as euro and all available to trade. Is that actually the amount that is open that you can still trade? So with what can you buy or sell stocks? I still have one order open to buy, and that's about 2,000 euros. So he has reserved that, and that 2,000 euros is therefore deducted from your free capital and is no longer available for trading. I also have it like the English one because I also make English speaking videos for our international company, business investors. But we set this up for the investors, which is in Dutch. So that's why you see that there are more languages than just English, but in principle, that doesn't really matter. Depending on your language, you can select the language you want. When you log into DEGIRO, you see an overview of the indices here. You can see on the right side, winners and losers are listed. All the information is here. You also see the top 10 list of the most popular ETFs. Also, the most traded stocks like ASML, for example. Of course, popular in Europe and all kinds of news. For me, it's all just noise. I would recommend you to avoid as much noise as possible. For example, those most traded stocks, it's not that important that they are the most traded. It's about buying good companies that you understand well, that you buy against intrinsic values. The price is lower than intrinsic values so that you have built in a margin of safety for uncertainties. Are you buying high quality companies that can also live a long-term sustainable success? If you go to favorites, you can add a stock that you want to follow to your watch list. For example, I can add an ASML to my watch list, but I do that myself because I use a different tool. Then I'm also going to apply a bit of buying and selling centers, but that's purely for inspiration and information for myself. We offer that as well, also on Happy Investors. If you look at the portfolio, you'll see an overview of the stocks. And yes, ETFs you've bought. So at the top, you'll always see the stocks you've purchased. Let's say you buy your first stock, then it will appear here in this overview ETFs, same story. I have it tailored to my needs. Watch TEF, the channel shares channel internet, TF. So you can see that here. You see an explanation. In this case, we're taking the first stock, ACM Research. You see a symbol here, a price. I'll explain later what that looks like. You see the value. So in this case, I have 4,000 euros in shares for ACME. However, I have a bit more because I'm at a loss of minus 21%. So minus 1,100. And actually, you should also add that up. So my total investment is around 5,100. Right now, the value is 4,000 euros. You see the average purchase price here. That's the abbreviation. My average purchase price is 20, but the current price we see here is $15. So yeah, that's minus 20% compared to the average purchase price that I have. And then it drops to minus 20%. Some stocks are doing really well. As you can see, some stocks are performing worse. I've shared a completely new update of my portfolio, and we do that every month. And then I'll provide more text explanation, how it comes that some stocks are not doing so well, because that has everything to do with the stock market at the moment, and how I position my portfolio for what I think is sustainable for the coming years. But I do try to invest my assets in quality companies like Booking Holdings or Evolution, where I still consider it one of my favorites. But I share that through the channel. So I would indeed recommend subscribing. Then you'll stay updated on these monthly updates of my portfolio and all the buy and sell transactions. Let's talk about that. If you go to an inbox, you'll see the messages you receive and the orders. So here you can see open orders. Well, I have placed one buy order at the moment for Landing Club. I want to take a small position because it seems promising to me. Small cap stock, so I can potentially rise a lot, but also risky. So I want a small position of $1,800. For my portfolio, that's about 1%. I also have a sell order here, but this is a stop loss. So I want uploving, selling a part of that at least at a stop price of 300 and more, 500. I'm going to show you how those buy and sell orders work. But first, let's take a look at some other things. If you go to transactions, you'll see an overview of transactions, last 7 days, last month, last 3 months, and you can select what your overview is. The monthly portfolio update that we publish every month, there I also show what my most recent transactions are. Finally, you can find your account statement. Here you find all sorts of factors like the costs you've incurred when you've purchased something. And we also see an example of dividends. So for example, here I have Booking Holdings and it has paid me a little bit of dividend. And Boye Frontline is the same, has also paid a dividend. And or Booking Holdings has also charged me a dividend tax. Yeah, no, Booking Holdings, but dividend tax is automatically handled through a platform. So if you're going to buy shares with dividends, dividend stocks, so you'll regularly find an overview of dividends. Dividend tax is automatically withheld. And in your tax return, that's probably already filled in automatically if you've indicated that you have an investment account. And then you'll also find an overview of how much dividend tax you need to pay and what you can claim back. And dividend payouts, regarding announcements, you'll find that below. So you go to the portfolio, you see your portfolio with open positions. You can also view your closed positions. For example, I had fully anonymous. I sold that. Then you can see here that there is a profit of so many percent, so many euros. It's, of course, about the open positions because those are still open. That's the most relevant. But if you scroll down, you'll find the upcoming payments. In other words, the upcoming dividend payment. You can also immediately see what is withheld as dividend tax. And depending on where you live, your country of residence, there are dividend tax treaties, for example, between the Netherlands and America, where a maximum of 50% dividend tax is applied. Finally, if you go to Inbox and Documents, you'll find the necessary documents you need for example, your tax return. Well, that's handy. The last thing is products, and here you'll actually find a complete overview of various products, shares from different exchanges and indices, the trackers, also known as ETFs, the bonds, any funds where you can have your assets invested, leverage products, and a few more like options and futures. I've been investing for over 10 years and I only do stocks and ETFs. The most important thing is to stay in the race. My returns don't do well every year. Sometimes they're really good, sometimes they're really bad. The most important thing is to keep surviving. I started with a small amount and now it's gradually increasing. I also have another investment account, by the way, with a pretty significant amount. The most important thing is to stay in the race. If you're going to use options, futures, or leverage, it can only turn out badly. I don't want to say that debt is bad. I personally enjoy investing in private equity firms. They obviously make use of debt, but in a very grounded way, and they know what they're doing. If you're a beginner in investing, there's a good chance you'll lose money. With leverage or futures, I think very big. So just be realistic about it for yourself and also decide what you want. I think the only way or reason to use leverage is if you're greedy and want to make money quickly. Yes, sometimes it goes well and sometimes it doesn't. So you can find a lot of stocks. I don't use these kinds of functionalities myself. Why? I use all kinds of screeners that I use for data models and other paid tools and databases. Do you want that kind of inspiration too? Well, at a little motion, go to our website, Happy Investors. Internationally, it's investors, and what we offer are different types of analyses of good stocks with high potential turns. A lot of reshares, goodbye. More established companies with a lower risk profile, but still attractive. Returns and dividend. Stocks with strong dividends and stable dividend growth. We also offer buy and sell signals on a weekly basis and an all-in-one package for those with a larger capital to invest and who want more security, including online guidance, where we also help you look at your portfolio objectively and minimize risks. So that's what I do regarding stocks. Well, let's go looking at part of the costs. You want to buy a stock, and that stock, which one do you want to buy? You first need to look into the costs, and that's especially important if you're going to invest with a smaller amount. What is a small amount? 50 euros, 100 euros, that's a small amount. Then you definitely need to take the costs into account. You can find those costs right in the overview on the website itself, in the rates. A small example you have. The most common ones are therefore American strawberries, or from Europe. For American stocks, you pay 2 euros transaction costs in total, but there's something else, namely the variable costs. You can see that here, that is 0.25%. Because I'm coming in with 100 euros, in this case for stocks worth $100, there's also 0.50% costs are deducted from my euros because you have to convert that to dollars. And on top of that, there's also a currency risk. If the dollar decreases in value over time compared to the euro, then I could also have currency risk. So depending on your entry point, you might want as much as possible. You might be able to buy euros. That also increases the costs a little, but the currency risk is also not very high because of that. But that can't always be the case. Then you obviously have to choose a euro exchange. For each exchange, you also pay 2.50 euros per year. That's explained here under connection costs. So for each exchange, you pay $250, and you do that every year. What does that look like if you have a portfolio? Then you see here the exchange or the stock exchange. Here you see the Nasdaq exchange as an abbreviation. This is the exchange from Sweden. The Amsterdam Stock Exchange. Nasdaq, York. TDG, Germany. Let me see if I can find another one. OTC, that's actually not common. Oh, EPA from Paris. So let's say just to make it easy, I have 5 exchanges. I pay 5 times 250 euros per year is 12.50 euros per year. But that's really nothing at all. So those costs you really shouldn't focus on. What's much more important is to look at what influence it has when you buy it. Well, let's take a look at a stock to buy. Let's take Google as an example. You've looked up Google and we want to buy Google. You can actually see 2 different ones already. Exactly. What is it now? Class A and Class C. Stocks also have what they call certain categories. Here's another example. I have a little share here, one from a very small company, Advice Lab Solutions, and behind it is a B. But you also have Advice Lab Solutions with category A. So you have category A or B, or in the case of Google, it's Class A or Class C. You also have Class B, and that has to do with voting rights and preferred shares. In other words, Class A are, in my opinion, preferred shares you can sit next to it, But let's say Google goes bankrupt and you have preferred shares, then you're a bit higher up in the hierarchy to get your money back. But the chance of getting your money back is still very low because bondholders are always at the top and first debt holders can claim their money, for example, suppliers and things like that. But you do see a slight price difference between Class A and Class C in this case, but both are listed on the stock exchange Netflix, and both are in the dollar currency. You can see that here, USD. So in this case, there really is a choice. Other stocks might have multiple choices. For example, we see ASML here. You see different stock exchanges, Amsterdam, Germany, and XET, it's also in Germany. And you also see the ADR here. That's the Nasdaq Stock Exchange, ADR. I don't quite remember what it stands for, but it actually means a certificate on a foreign exchange. To put it simply, it doesn't really matter much. What does that mean? You do see different types of stock exchanges. So I could choose to buy ASML on, the Nasdaq. I've always bought ASML on the Amsterdam Stock Exchange. And you see euros, dollars written back here. In this case, we wanted to buy Google. What we remember, let's just choose Class C for convenience. We can buy or sell right here, or we can just click on it. It's then open. What you see then is an overview of stock. You can also see all sorts of things like financials, ratios, ownership. I'll get back to that in a moment. We need to go deeper into this, but I personally use other tools, so I'll explain how and what. We're still in the process of buying, and we want to buy some shares. We're going to take a first position. We've seen the price is $192. Now, let's say you just want to buy immediately at this price. Then you set it as a night order and choose market price. That's just the price that's available right now. And you click on one because you want to buy one Google share. When you click place order, you can see what your cost overview is. In this case, euros. But what's not mentioned here is that you also have to pay currency costs of 0.25%. So those costs definitely add up. And this is not the complete cost overview, so close attention to that. In this case, I just want to buy using a market order. And if I press confirm now, it will probably buy today when the stock market opens. The stock market has to be open, of course, to be able to buy. And that is sometimes relevant if you're thinking, yeah, I want to buy Google now. Let's say for 192, you see I'm now choosing a limit. So my limit price is I don't want to buy above 192. I'm buying at 192. Not, so it won't be activated at 192.1 or 192.3 or at 94, 95, but it is now being activated. Only if the price is at that level, then you call it a limit order. Often you don't use a limit order on a daily basis, but for the longer term, the abbreviation is good till cancel. In this case, it says something different here depending on your settings. That means it remains valid until the order is activated or after 3 or 4 months. Something like that. It gets automatically activated if it hasn't been activated. You usually use limit orders when you want to buy at a low price. So let's just say for convenience that Google is currently a bit down. By now, you know that the valuation has increased because you've delved a bit more into investment valuations and you know how that works. And you think, well, let's say if Google drops to a price level of 190, then I'm interested again. Or better said, for example, at a 3-month level, it has dropped once to, I'm just saying, randomly 170. I want it at 170. What you do then is you place a limit order at 170 and set it to good till cancel. And you set the quantity, in this case to 1. You can also see the total amount for the purchase is now 165 because you indicate I'm buying for $170. And then it also converts to the euro currency. So you pay a maximum of 165. Place order confirmed. The connection has now been confirmed. And then the buy order is created. What does that look like? Then you see in orders, you see a buy order created here. In this case, Lending Club. I want to buy it when the New York Exchange opens. And I want to pay a limit price of $15 and 120 quantity. So 120 times 15 dollars is 1,800. in total as the purchase price. Now let's say the price never hits $15, then it stays open here. And after 3 months it expires, or after I don't know how many months it expires, and then it hasn't been bought. We're going back to Google. You bought Google, and in this case, the price has risen significantly. So we said that we bought it for the convenience of 70. That was our example. And you think it's going to rise again. But if it then rises back to, for example, that price of 200, then you want to sell. Now, let's say the price is 170 instead of 190, and you can sell right away. So here too, instead of buying, you sell, and you do it as a market order. You set the quantity to 1 and you sell immediately. If you click on place order now, you still need to confirm, and then it sells right away for the price. The price in this hypothetical situation is then 170 and not 190, because you bought it for 170 and you're making a profit, so sell it. But then you sell it right away. Let's say you just bought it for 170, or say today you're going to buy it for 190, and then you don't. So you first created a buy order as a market order, and he says, well, I actually want to automatically sell Google if it hits a certain price. You have to determine for yourself why you want to do that. But that's aside from this explanation. You do automatic selling with your limit. So instead of a day order, I want to create a long-term order now. So that's what I call it. I'm setting it to limit. I bought it for 192 and now I want to sell it for example, 130. I bought one and that's converted here. $230 to euros is 224 euros. And automatically in the future, when Google hits this price, that hits 230, then it gets sold automatically. That happens completely automatically. You could be lying on the beach. You could be working out, studying, or working. If it hits 32, it gets sold. Place order. It doesn't do that for me because I don't have any Google shares. If I had it, then I should have been able to confirm it. If you go back to buying, actually, most common third is you buy with a market order. These days I buy for 192. Or I say, well, no, I just want to buy for 170 because I think it's going to drop one more piece. We've covered that now. Now, suppose you want to Google, you bought for 192. So you bought with a market order, you bought Google 192, and it has actually gone up and you want to limit your losses afterwards, for example. What you can also do is go to sell, and then you tap on stop. And then with the stop loss, I know that the price is now, for example, 100, and it might drop to, for example, 80, and then it drops even further. Then you want to automatically sell at a price level of 80, for example, because you just want to limit your losses. But let's say that more traders who use price charts and day trading often rely on price strength. They often set a stop loss at around 20%. Well, it's quite coincidental that this example is minus 20%, but usually they set it at minus 20% relative to the current price. So then you have to do 192 minus 20%. Let's round it off to, let's say, 160. We're setting a stop price of 160. We're setting this up again for the long term. We bought one number. What's happening now is for whatever reason, you bought Google for 92. And of course, you expect or hope that the stock will go up because you did your research and you have a high quality company sold. You expect to make more profit, but you never know. You just want to limit your risk with losses for whatever reason. And at minus 20%, you just want to stop your loss. And then you have your stop loss in place. That's why it's called stop loss. You stop your loss. Actually, it's that simple. So see, such a stop price. You had one and you press place order and it someday dropped to 160. So it's currently at 192. And from what we remember, it drops back down to 160 below. Yes, if it happens, then it gets sold automatically. Then you don't have to do anything yourself. Let's now see an example of how I do that. Very occasionally I apply it because I rarely use a stop loss, but I only use it when I have a few that have performed very well and might be overvalued. And I think the chance of a decline is likely when I have a few that have performed very well and might be overvalued. And I think the chance for decline is likely. An example that happens to be in effect right now because I rarely use a stop loss. I usually buy more at minus 23 or at minus 40%. I just buy more. I find that logical. But yes, traders or swing traders do make more use of stop loss. But uploving has increased a lot for me. Uploving. You can see that here. That has increased by 60%. Was a little more. I just feel like, well, I want to cash in some of my profits when the 305 is reached. We see the orders uploving. So I don't want to sell everything because I have 65 shares, but I want to sell 54 at a stop price of 3 out of 5. I just think that uploving may have become overvalued because it has skyrocketed this year. It's an incredibly high. So I bought uploving in December 2023, and I bought more again at the beginning of 2024, and it is indeed up about 86%. Where we bought more a second time, it's a total of 26% for me. And you can see it was actually already higher, but it has actually dropped a bit. So we see this is at a known level. It was once a bit higher, so it has already dropped by 24%. So that seems pretty much right to me. And I said, well, yes, at a price of 305, then I feel like, then I just want to limits. But luckily, uploving has actually been fluctuating just above 305 for a long time. So look, hit 303, I think it hit 308 somewhere, and it stays just above that 305 euros. So yeah, that stop loss, it hasn't approached 305 yet, so it just remains activated. This stop loss, what happens now if uploving does drop further? Because it's currently at 315. Is it going to drop further? Because it's currently at 315. If it drops to, for example, 280 now, then it needs to drop a bit more. And then this stop loss will be activated. Then the part is automatically sold. And then my free capital comes in, is increasing again. And then the way loss is taken off. And that's how you can apply the stop loss. Now, in the last part, I want to briefly explain a few terms that are important when investing in stocks or buying and selling shares, and make sure to pay attention to this. A lot more explanation and text is needed to understand what we're really talking about now. So here is a kind of quick explanation of a few important ratios, figures, and characteristics. But definitely follow our channel for much more in-depth explanations about stock analysis. We also frequently share tips and inspirations for potentially attractive stocks. It's all completely free for you to follow. Uploving is a great example. Uploving currently has a risk category of D. You have A, B, C, D. D is actually the lowest as far as I know for stocks. But ETFs also have a risk class, although that's of course safer than a stock. So uploving is very risky, and that just has to do with the financial situation they're in. But uploving has also increased a lot in terms of returns. So this is actually a really nice example to clarify a few things. For example, you can go to ratios at DEGIRO, and then you'll find a number of terms. And here it says, for example, price to earnings. P writes in E. And that stands for price to earnings. So price is 305, and you divide that by the number of shares and how much profit you're making. And then you get the price to earnings, and that is very important. So basically a good growth stock. For that, the price to earnings is 25, is everything tilted towards the height. But sometimes, for example, it can be 35 or 40. If the long-term growth is really attractive, because we're not going to look at investing, always in the future, once again, this is all very simplified. You need a lot more explanation to learn this well, understand. But for example, a company that has almost no growth potential left, then there's a price for earnings of 10. That's already a lot. You often see that with a company that pays out high dividends, almost unable to grow. They always have a much lower valuation. So the price to earnings of uploving at this moment has risen to 95. And that TTM, that stands for the last 12 months. But what you mainly want to know is, what is the price to earnings ratio for next year? For example, we had Google here. We see this is actually the tool that I use. In our YouTube description, you'll find all sorts of summaries of tools that we use and can recommend. And we see here the price that EODX stands. That GAB, that's actually just the amortization of a certain financial statement, what the accounting must comply with. So that's to ensure that not too much fraud is committed. And TDM is for the current 12 months. And forward date means next year. So in this case, Google it's not going to generate a lot of profit. So the price to earnings will also not be much lower than that. So if a company realizes a lot of growth, then price to earnings will be around 20. And that's also super important for the valuation, especially at the future. So then you have a ratio called the PR ratio. That stands for price to earnings ratio. You have the EPS, that stands for earnings per share. So how much profit per share does the company make? That's really a crucial number. You need to know if you're going to invest in the stock. You obviously want to see that it achieves certain growth over the next 3, 5, or even longer years. Let's say it's 10% and the current price to earnings is 25. Then you can do a calculation for that. So in this case, the PE ratio takes into account the future price in relation to the earnings growth. You also see an explanation here. It is on the screen. Actually, a PE ratio below 1 is the most favored because that means the stock is undervalued. But in this case, Google, because it's a high quality company with a very strong market position. For example, do you want to buy Google when it's below 2 or maybe below 1.5? Why? Because the certainty and profit growth in the longer term future of 5 to 10 years, that's more certain because Google is a great company. So you have a lot of terms, and I can imagine that as a beginner, it can be really difficult. So you definitely need to pay more attention to learn this, understand, read books for that, follow videos from other YouTubers like us, but also take our course, follow along for investing, where we explain this very calmly. Explanation with a lot of practical examples. For instance, you also need to know what the price to sales ratio means. That's actually the price in relation to the revenue. The price to cash flow is super important. The price to free cash flow might be even more important. That means the free cash flow that a company has. So you have to imagine that a company makes a certain profit. I'll just make it concrete right away with an example. Just really quickly, you're going to the cash flow statement from companies. You see what the net income is. This is the net profit, and various factors come off of that, like depreciation. Some things are added, a few more things are deducted from that. And in the end, you have the cash flow here, the breakdown, the operational cash flow. At Google, it's really big because this is a very large amount. And then you actually see the price adjusted with the cash flow. It comes from dividing the price by this metric. Here, the cash flow. But Google also has a lot of capital expenditures or CapEx expenses. For example, in this case, for data centers. So you have to subtract this from it. So you calculate the free cash flow by reducing the cash from operations with the capital expenditures of that year. That is the free cash flow. Capital expenditures for that year, that is the free cash flow. Of course, companies prefer to consistently grow their free cash flow because then they can keep investing more and more in their growth. The price to book value is also very important, and of course, all sorts of other metrics like net debt, EBITDA is super important. That is the earnings before interest, taxes, depreciation, and amortization. All these terms are super important to know, but I'm going to explain them in this simple way. Video on how to buy and sell stocks with DEGIRO. That goes too far, then we would be another hour in, and the video is already long enough. So thank you for watching. There are probably a lot of questions. Very good, ask them. Do you have any additions? Please feel free to add to them. Help each other understand how to buy and sell stocks. And especially pay close attention to what you're doing. If you don't know what these terms mean, then you're probably not quite ready to buy stocks. No shame. Doesn't have to. You can learn it, first of all. And secondly, you obviously have low risk investments as an alternative, like me, exchange traded funds. And we have a lot of video explanations there as well. Last year available on our channel. So I would really appreciate it if you could give this video a like, and more if you want, subscribe. Why? That helps our channel grow within the algorithm. The bigger our channel gets, the more money it generates, the more money we can invest in. Making videos, free content that helps you with simple investing and becoming financially free. Thank you for that, and see you next time.